Good morning from cool, sunny Chicago, where the 4-3 Chicago Bears will face the Cincinnati Bengals in Cincinnati, Ohio this afternoon. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, November 2nd, 2025. In today's podcast, our focus is on the benchmark S&P 500 incredible 43% rise from its April 7th low in just a little less than 7 months, and where we think the risks lie as we look towards the end of the year. Our late June upside target of 69.50 was essentially met last week as the S&P traded as high as 69.20 intraday on Wednesday. So considering that corrective declines often begin once upside price objectives have all been met, I'm going to be paying special attention to our own models like the Asbury 6 and the correction protection model, which we call the CPM here, for indications that a long overdue and potentially nasty corrective decline is beginning. We have had quite a year so far in 2025 as three of our four model portfolios, Asbury Aggressive, Asbury Balanced, and Asbury Conservative, have all outperformed the S&P 500, and what's most important to us, all have had lower maximum drawdowns, lower standard deviation, and a lower beta than the S&P. Now our focus is on keeping our 2025 open profits and avoiding the inevitable correction, which, once it occurs, should provide us with another opportunity to buy the market again at much cheaper prices, just like we did back in April. Before we get started in looking at our latest charge data and some of our updated models, here's a little bit of info about us. Asbury Research is a registered investment advisor and has been providing both investment research and model portfolios asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have two levels of research service available. Number one, our bellwether, I guess you'd call it, Asbury Premium. That's what we started the business on in 2005. It's geared for more serious investors, more active investors, more sophisticated investors. A lot of information there. It includes the latest updates on all of our models and some personal instruction via Zoom on how to implement them into your portfolio. You're looking at the landing page for that service. We also have our entry-level Substack newsletter, which is relatively new. I think it's a couple years old now, for $25 a month. Here it is here. Address asburyresearch.substack.com. It does not include any of our trading models, but it offers some selected reports from the premium service and a special model that we built exclusively for the Substack. There's also a free version of the Substack newsletter. So if you like our videos, you like our approach to markets, maybe you've seen us around the internet as we do interviews and presentations for IBD and Schwab and for Fidelity, I strongly suggest that you sign up for the free version here on Substack. It's kind of a no-brainer. It'll give you more insights into how we look at markets and some ideas as to where the money is going as it kind of moves around the world. And again, you could do that at asburyresearch.substack.com. In addition, individual investors, financial investors, and RIAs can also access Asbury Research model portfolios via managed accounts available on the Charles Schwab trading platform. Financial advisors and RIAs can also have access to our model portfolios through a TAMP, which is an acronym for a turnkey asset management platform. We have created four model portfolios: Asbury Aggressive, Asbury Balanced, and Asbury Conservative, as we mentioned, and also Ultra Conservative, all using our CPM model, CEF model, and other models as building blocks. If you've ever seen the movie Moneyball, which is it's one of our favorite movies around the Kosar household. It's about how Oakland A's general manager Billy Beane built a baseball lineup using quantitative metrics and basically turned baseball on its ear, changed the game forever. This is essentially our idea on how we built our model portfolios using our own individual models as players in the lineup. Contact us via the contact tab here right in the corner in green at asburyresearch.com to request more information and fact sheets about these model portfolios. Okay, now let's get going. And we're going to begin by looking at the Asbury Research, or the Asbury 6 rather. We're going to go to the Research Center and click in there. This is the paywall. And we're going to go to the Asbury 6. For those that don't know this already, this is probably the metric that we're known the most for. We talk about it when we go on interviews all over the internet. It's a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected via quantitative backtesting. Every individual indicator has an Achilles heel. And no indicator works all the time. That's why when somebody asks me if I have a favorite indicator, I don't, because there are situations, certain environments within the markets where a certain indicator is not going to work, even though it's otherwise pretty reliable. So what we did is back-tested all of my favorite tools in my 40 plus years of being in the business, and we put 6 together that work well as a team. So rather than getting kind of knocked off of our game on these crazy days that we had a bunch of them here over the past couple of weeks where the S&P might be up 60 or 70 in the morning and down 50 by the afternoon. We focus on the Asbury 6. It's meant to be an indicator rather than a model. Think of it as an EKG for the stock market. So it's been positive since October the 20th. 4 metrics in one direction. Green metrics would be positive. Red metrics would be negative. Right now we're 3 and 3. So what does that mean? That means that we're still on the positive reading in the model since October the 20th, but now we're equally balanced at 3 and 3. What does that tell us? That tells us that either the S&P 500 or the market in general, next week it needs to firm up and start another leg higher and move towards 7,000, which is going to be a psychological level for the S&P, or we're going to roll into some kind of a minor correction. Or at least it's going to be minor in the beginning. So we're watching this really close. If 4 of these metrics go to red next week, that's going to be the first indication for us that the market is starting to lose its internal strength, and that could be the precursor to going into a correction. Next, let's go back to the Research Center and go to our CPM, a correction protection model that I mentioned earlier. This, unlike the A6, is actually a model. It's a building block in our model portfolios. I use it for my own account and have for many years. Let's get there. So all we're doing is going over to the Research Center, going to CPM. And there it is. CPM has been risk on as of October the 21st. CPM is a completely data-driven dynamic stocks bonds allocation model. It was designed to be an alternative to the standard 60-40 portfolio, where if you've ever worked for if you ever worked with an advisor, a lot of the programs that they build are based on that 60-40 portfolio. Just for perspective, let's jump over here and have a look at a chart. This is what we want here. AOR is an ETF that emulates a 60-40 portfolio. That's the blue line. CPM is the green line. So it's actually giving you the protection that some think that the 60-40 portfolio gives you, which I would have an issue with that. In 2022, both stocks and bonds went down at the same time. So I don't know about the viability of the 60-40 anymore, but the CPM has outperformed it quite a bit over the past 7 years, and you're still getting the downside protection because CPM is either in cash or it's in the S&P 500. In our portfolios, we substitute cash for a short-term treasury ETF, something like BIL. It's designed to protect investors during market declines, eliminate the large drawdowns, and reduce volatility in portfolios by again moving assets out of the stock market during adverse conditions. Let's go back to the research center, and you can see kind of what this has done here over the past couple of years. Most recently, we avoided about half of the drawdown that we had between February and April of this year. We went back to risk on April 24th. We had a brief period where we went to risk off between October 10th and 21st, and now we're back to risk on. So should the A6 start to turn negative, 4 or more red next week, and then we see the CPM goes to risk off, that becomes actionable for us. It's time to start to protect profits. It's time to start reducing your equity exposure. CPM year to date, it's a relative performer, but with less than half the maximum drawdown. Maximum drawdown here in the S&P was 18.9% this year. It was 9.3% in CPM. It's got a lower standard deviation and a lower beta. Let's talk about those words, because not everybody knows what these mean. A lower standard deviation indicates smaller price swings and a narrower range of potential returns, implying more consistent returns and lower risk. So that's what standard deviation is. Beta is similar. A strategy with a lower beta suggests a more stable investment, and it's less volatile than the overall market. So the S&P is assumed to have a beta of 1. If a strategy has a beta of 0.6, then it's 0.4 less volatile than the S&P 500. Here's why these drawdowns are so important. We talk about drawdowns a lot here, and this is why we do. Let's begin here. This is CPM yearly drawdowns versus SPY, versus the S&P 500 annual drawdowns. 2018, CPM had a 15.1 drawdown compared to 19.8. It's 4%. It's not huge. Look over here during COVID. COVID drew down 33.9%. The S&P only drew down 9%. This year, S&P drew down 18.9 this year between February and April. CPM drew down 9.3. Why is that important? Because the bigger the drawdown, the more money you have to make the other way to get back to where you were at the top. And as you get older, I always equate it to football. Playing football in the fourth quarter is like investing in the fourth quarter of our investment lives. I happen to be there right now. I think people in their middle 50s on higher are in that situation. When you're young, you could dollar cost average. If the market goes down 30%, good. You're buying every time you get paid, and you're accumulating a nice dollar cost average. Once you get in that fourth quarter of your investment life, the game changes. You don't throw the ball up in the air. You don't do a lot of handling the ball behind the line of scrimmage. You give it to your big fullback, and you let him take what the market gives you, so to speak. I know I'm mixing my metaphors a whole lot here, but you get the idea. During COVID, the S&P drew down 34%. Here it is here. If you draw down 30%, the way the math works, you got to make 43% the other way in order to get back to where you were. That's why we focus so much on the drawdowns. If you can keep the drawdowns lower, especially if you're starting to take RMDs, if you experience a huge drawdown, 30% drawdown or more, which again, we're up 43% in 7 months. If we experience a big drawdown and we're taking RMDs, the 1-2 punch of both of those can really change how long your money lasts as you go through retirement. So that's why we spent so much time there. Let's go back to where we were and take a look at some sector rotation. So we're going to go back to the Research Center, and we're going to look at our SEAF model. SEAF is an acronym. It stands for Sector ETF Asset Flows. And what this does, we built an algorithm that measures the velocity of money as it moves around the 11 sectors of the S&P 500. The model is the back-tested version of the model, which is a building block, which is another building block for our model portfolios. It always invests in the top 3. That means the money is moving into those sectors the fastest in multiple time frames of weekly, monthly, and also quarterly, which we call strategic. So right now our top three are XLK, XLU, and XLV. Note that we've got both offensive and defensive sectors in the top three. Technology and utilities now are both considered offensive sectors. Healthcare is very defensive. And down at the bottom, the money is coming out of XLP, Staples, XLE, Energy, and XLF, which is financials. So that's where the money is going. That's where invested now. Unlike CPM, the CEF model is always fully invested in the market, which provides investors with a dynamic alternative to that traditional buy and hold portion of your portfolio. Most people that I've dealt with over the years, myself included, I never go totally out of the market. There's a piece that stays in the market all the time. This is meant to take the place of that static piece that might be in the S&P 1500 or something of that nature, or the Russell 3000. This is dynamic, and that's always where the money is going, and avoiding the places where the money is leaving. Since inception in mid-2018, CEF has significantly outperformed the S&P 500 on an annualized basis with better risk-adjusted numbers like the Sharpe ratio. If you don't know what that is, you can contact us for details on anything that we're talking about here, and we'll try to explain to you what those things are, or at least be able to send you somewhere where you can get better information. Next, we're going to look at our ETF trade ideas. These are trades rather than investments. The average trade is about a month long. Average winning trade, rather, is about a month long. Average losing trade is about 8 trading days, or about a week and a half. Our losers are twice as big as our winners, going back 2.5 years. And we are right about 54% of the time. So it's a winning strategy over time. Let's look at currently what's an open idea for us. Let's look at IBB. IBB is the iShares Biotech ETF. So we put the trade on 10/16. We'll take a look at it here. So the trade went on here at 10/16. So we've got a little lead here, 4% and change, and it's outperforming the S&P 500, which is the bottom panel down here. That's what we're looking at. We're looking at trend, relative performance, and what you can't see here, we're also looking at asset flows. If we get those three components working in our favor, that's when we take these ideas. You can see we've had a couple of nice ones here just over the past few months. We were in Ring, which is the gold miners, from August the 6th. We got out on October 21st. We made 31% outright and actually outperformed the S&P by 31%. We were in Palladium for a while. XME, was another one. But all this is using quantitative scans to find out that the trend, that the relative performance and the asset flows are in our favor. And from there, I use my 40 years of experience to try to determine which of these have the best risk-reward ratios. And then we take those trades. Next thing we're going to go to is Keys to This Week. That's our weekly report, as the name suggests, that Jack and I probably look at 120 charts, 150 charts. We pull out 10 that we think are the most important to watch, the most germane to what's happening in the market right now. So let's just look at a few of these. This is from October 31st, from Friday. And first chart we're going to look at is chart 2. And this shows IWM, which is the ETF that tracks the Russell 2000. You can see that it's been trying to get above its November 2021 high for weeks. 244.46 is where that is. The longer we stay up above there, the more likely that there's another leg higher in the overall market, because the linear correlation between IWM and SPY has been 0.9, 0.95 in that neighborhood for the past 20 years. So as goes IWM from here, so is likely to go the rest of the market. So small caps a focus for us right now. Next one we want to look at is a relative performance chart that basically says how stocks are doing versus bonds. This is the SPX in the upper panel. Lower panel we've got the relative performance of SPY versus AGG, which is the ETF. It's the aggregate bond index. You can see it started moving above its 63-day moving average, which is a business quarter, on May the 6th. Tested it here at the beginning to middle part of October, and now we're making fresh highs. Fresh highs in the relative performance chart, as well as in the S&P 500. As long as SPY continues to outperform ag, stocks continue to outperform bonds, the environment is healthy for the stock market to keep going higher. Let's move to chart 6. And what we're looking at here is volume. This is cumulative volume, which is different than raw volume. It's a little bit smoother, but you can see basically since the middle of August, cumulative volume has stayed above its 21-day moving average, which is our tactical time period. We had a couple of little missteps here, middle of October, that gave us this little dip in the S&P 500, which there was no follow through. This was that crazy day that we had on October the 10th, that we stayed inside of that trading range for almost 2 weeks. Look what's happening now. As of October the 30th, we are underneath that 21-day moving average again, which means that the urgency to buy is starting to erode. It's starting to get soft. The more time that we spend underneath the 21-day moving average here, the more likely that we're making some kind of a tactical top here. That would also be reflected in the Asbury 6. So we're watching this in conjunction with the Asbury 6 for next week. Here's number 8. Actually, this is number 9 that we wanted here. This is SPDW, which is the Global Equities ETF ex-US, without the US. And what this is starting to show here is, you remember from February into April of last year when the market was weak, there was a lot of outperformance going on overseas. You saw it in South America. You saw several in the Asia Pacific region. What this is telling you is really since June the 17th, SPDW is underperforming. So that means if you're looking for opportunities elsewhere, overseas, it's too soon for that. We want to see this index start to outperform again like it did between February and June before we start to buy or start to look for opportunities overseas. Next, the SORT report. We're going to talk about the SORT report, which is a part again of our entry-level Substack. Here it is here. Let's make it a little bigger. There we go. It's part of our entry-level Substack online newsletter. It's called Chart Focus. Again, we mentioned the service is $25 a month. There's also a free version. There's a Substack link below this video so you can sign up if you like for the free version. The SORT report tells us what parts of the global market have positive trends, are outperforming their benchmarks, and have positive asset flows, which are the 3 legs of the stool for us, which means that new money is pushing these ETF prices higher. This is a very low-cost way to make better investment decisions that are based on data, not opinion or economic forecasts. Forecasting to us is a euphemism for guessing. I want to know what the data says and I want to follow the data. What this is showing us right now is the only asset here between U.S. technology, emerging markets, commodities, global equities, ex-U.S., which we just actually looked at with SPDW, interest rates, dollar, crude oil, small cap, gold, crypto. It's a pretty wide swath of assets here. The only one that is clicking on all 3 cylinders right now, trend, relative performance, and money flows, is U.S. technology. So if you're looking for opportunities globally, U.S. technology is still the place to be. So there you go. That wraps up our latest Asbury Research is Following the Money podcast. Our next Following the Money is tentatively scheduled 2 weeks from today, Sunday, November the 16th. I hope to see you then. In the meantime, if you have any questions or want more info on any of the research models and model portfolios we talked about today, you can contact us right here at the contact tab at asburyresearch.com. And don't forget to like and subscribe. I'm off to watch the Bears. Have a great Sunday.